Now in the previous video we discussed about the other chapters. Now we'll look at the questions based on the accounting standards and the framework. A Limited has entered into a binding agreement with Gamma Limited to buy a custom made machine for 1 lakh. So who has entered? A has entered into a binding agreement with Gamma Limited. At the end of year 2, before the delivery of the machine, A Limited had to change its method of production. The new method will not require the machine ordered and it will be scrapped after delivery. Expected scrap value is nil. Now what has happened? We said we will buy. We have entered into a firm commitment. We said we will pay 1 lakh. Now before the machine has been delivered, we had to change the method of production. Now the machine will be useless. We have to scrap the machine. Now when you have entered into a binding agreement, we have to honor. The other party will not, say that, okay, because you have changed the production method, no need to pay and all that. So there is an obligation to pay 1 lakh, and in return, will we get an asset? We'll get an asset, but the value of the asset is what? Nil for us. It doesn't have any value because there will not be any future economic benefits coming out from that asset. So there is an obligation to pay this 1 lakh, and that is fully a loss, right? So you will have to create a liability for this 1 lakh and also recognize a loss for 1 lakh. You are required to advise the accounting treatment and give necessary journal entry in the year ended year 1, year 2. Now one more thing, what you need to understand is, before the end itself, we have changed the method of production. Before the machine was delivered, machine may have been delivered in the subsequent period, but you have changed the method of production, and hence this contract is no longer beneficial to us. We also call them onerous contracts, right? And because of that, we will be incurring a loss, and for that we need to create a liability. So let's see. A liability is recognized when the outflow of economic resources in settlement of a present obligation can be anticipated and the value of the outflow can be reliably measured. In the given case, A Limited should recognize a liability of 1 lakh to Gamma Limited. And when the economic benefit to the enterprise beyond the current accounting period is considered improbable, the expenditure incurred is recognized as an expense rather than an asset. In the present case, flow of future economic benefit from the machine to the enterprise is not probable, and hence the entire amount of purchase price of the machine should be recognized as expense. So you will recognize a loss and the amount payable to Gamma Limited and then P&L to Gamma Limited, right? A simple one. Then let's look at the next one, AS1, based on AS1. In the books of Rani Limited, closing inventory as on 31st of March amounts to 1,75,000 valued on the basis of FIFO method, first in first out. The company decides to change from FIFO to weighted average method for ascertaining the cost of inventory from year 21-22. On the basis of weighted average method, closing inventory as on 31st March of 22 amounts to 1,59,000. Realizable value of the inventory as on 31st March of 22 amounts to 2,07,000. Discuss the disclosure requirements of change in accounting policy as per AS1. A very simple one. As per AS1, when can you change the accounting policy? Either if it is required by a standard or statutes, or it results in a better presentation, right? So you can change the accounting policy, and if there is a change in accounting policy and if the impact of that is material, you have to disclose. Now here what will you disclose? Here you will say that earlier the company used to follow FIFO method at which the value of inventory would be 1,75,000. Now when they change from FIFO to weighted average, now the value of inventory is 1,59,000. Means what? The value of inventory has gone down. If the value of closing inventory has gone down, there is a consequent impact on the P&L as well, and the profit for the period is lower by 75 to 59, 16,000. This is what you need to disclose. As per AS1, disclosure of accounting policy, any change in an accounting policy which has a material effect should be disclosed in the financial statement. The amount by which an item in the financial statement is affected by such change should also be disclosed to the extent ascertainable. Where such amount is not ascertainable, the fact should be indicated. Thus, Rani Limited should disclose the change in valuation method of inventory and its effect on the financial statement. So, the company values its inventory at lower of cost and net realizable value. Since net realizable value of all items of inventory in the current year was greater than the cost, company valued its inventory at cost. In the present year, the company has changed to weighted average method, which better reflects the consumption pattern of the inventory. For ascertaining the inventory cost from the earlier practice of FIFO, the change in the policy has reduced the current profit and value of inventory by 16,000. See, this is one way of presentation, right? Exact words need not be reproduced. The essence is, if it is material, you need to disclose the amount, right? And when you're disclosing, you have to draft a paragraph which explains what was practiced earlier, what is practiced now, and what is the impact. Moving on for AS2. An enterprise ordered 20,000 kgs of certain material at 110. The purchase price includes GST at 12 per kg, in respect of which full input tax credit is admissible. Freight incurred amounted to 1,17,000. Normal transit loss is 2%. The enterprise actually received 19,500 kg and consumed 18,000 kg of the material. You are required to calculate cost of material per kg, allocation of the material cost. Now, what do you require to do? How much is the cost? So, from 110, you will reduce how much? 12. So, you get 98, right? 98 into 20,000 is your basic cost. Then 1,17,600 you will add, right? And 20,000, the normal transit loss is 2%. So, 2% of 20,000 is how much? 400. Okay. So, 19,600 is the expected quantity. Whatever is the cost you get, this purchase cost plus freight, that you will spread over 19,600. Then you received how much? 19,500. 100 is the abnormal loss that you will calculate. And out of 19,500, 18,000 is consumed. So that is cost of material consumed. And how much will be left in inventory? 1,500. 1,500 will be your closing inventory. Very simple. Purchase price 20,000 into 98, you get 19,60,000. Add freight. This is for normal input or normal material that you would receive of 19,600. Then normal cost per kg is 106. Material consumed 18,000. Cost of inventory 1,500. Abnormal loss 100. You will recognize separately. Right. Then it's a very simple one. Nothing complicated there as well. Then AS10 on property, plant and equipment. Star Limited purchased a machinery for 680 inclusive of GST. So, thing is input credit is available. So, 680 minus 40, you will take 640. The company incurred the following other expenses. Cost of preparation you will include, labor charges you will include. 200 out of the total of 500 man hours worked were spent on installation of the machinery. Okay. So, total is 56,000. This 56,000 is for 500, but you have incurred only for 200 for machinery. So, 200 proportionately will add. Spare parts and tool consumed in installation, this you will add. Salary of supervisor, time spent for installation was 25%. So, this into 25%. Then, total technical expense 1/10 relates to plant installation. So, this multiplied by 1/10. Then, test run and experimental production expenses related to acquisition of PPE. Consultancy charges attributable. Depreciation on assets used for installation. So, some other asset is used, on that there is depreciation, that is also attributable. So, all of this you will add to the cost of PPE. Machine was ready for use on 15th of January but used from 1st of February. Due to this delay, further expenses of 8,900 were incurred. Now, these are the this is the expenditure which is not incurred for bringing the property, plant and equipment to its current condition and location. So, this will not be considered. Calculate the value at which plant should be capitalized in the books. So, remaining all I have done it here. Apart from that, you know that 8,900 will not be considered. So, purchase price you will take less GST credit 40,000. So, 680 minus 40,000. Then, site preparation you will take, labor charges you will take, spare parts you will take, supervisors, technical cost, test run, architect fees, depreciation, right. You will not include the cost of 8,900. Very, very simple. Then, moving on. ABC Builders Limited had borrowed a sum of $15 lakh at the beginning of financial year 21 for its residential project at London Interbank offered rate. This is a benchmark rate plus 4%. The interest is payable at the end of the financial year. At the time of availing the loan, the exchange rate was 72 per dollar and the rate was 76. If ABC Limited borrowed the loan in Indian rupee equivalent, the pricing of the loan would have been 9.5%. Compute the borrowing cost and exchange difference for the year ended 31st March of 21 as per the applicable standard. Applicable LIBOR is 1%. So, rate is what? 1% plus 4%, which is 5%. Okay. Now, they have borrowed a sum of how much? 15 lakhs. So, 15 lakhs pay at 5%. How much we have to pay? 15 lakhs dollar into 5% is $75,000. $75,000 is something that you need to pay to the bank as interest. Now, out of the 75,000, how much is borrowing cost and how much is exchange difference for the year ended 31st March of 21? That is what we need to calculate. Now, what we need to do is, now 15 lakhs you have borrowed in USD and on that date, what is the rate? 72. So what is the amount borrowed? 15 lakhs into 72. So amount borrowed is 15 lakhs into 72. Okay. Then there is an exchange fluctuation on this 15 lakhs when it moves from 72 to 76 because the rate has increased. 15 lakhs into 4. 15 lakhs into 4. 60 lakhs is your exchange difference. Now out of this exchange difference of 60 lakhs, you have to calculate how much relates to interest savings, because applicable Indian rate is 9.5 and your borrowing rate is 4% plus 1%, which is 5%. So 9.5 minus 5, to that extent of amount that you have saved, that amount will be considered as borrowing cost and balance amount will be considered as exchange difference. Interest for the period is 15 lakhs into 5% and closing rate 76, it is 57 lakhs. Increase in liability towards the principal amount is 60 lakhs. So total interest for the period is 57 lakhs. Exchange loss is 60 lakhs. Interest that would have resulted if the loan was taken in Indian currency is 15 lakhs into 72 into 9.5%, which is 102.6. Difference between these two, 45.6 is your savings. 45.6 lakhs is something which you have saved. Therefore, out of 60 lakhs increase in the liability towards the principal amount, only 45.6 will be considered as borrowing cost. So 60 lakhs of exchange loss, out of that 45.6 will be considered as borrowing cost, and the borrowing cost would be how much? 102.6 lakhs, which is 57 lakhs that you will pay in USD terms and that 45.6 lakhs that you have saved. And hence 102.6 lakhs will be accounted for as borrowing cost and balance 14.4 lakhs would be considered as exchange difference. Very simple again. Then Hygiene Limited had received a grant of 50 lakhs in 12 from a state government towards installation of PCM, pollution control machinery, on fulfillment of certain conditions. The company, however, failed to comply with the said conditions and consequently was required to refund the said amount in 2022. The company debited the said amount to its machinery account in 2022 on payment of the same. It also revoked the depreciation for the said machinery from the date of its purchase and passed necessary adjusting entries in 22 to incorporate retrospective impact of the same. Now here, see, there is a grant of 50 lakhs. Okay, what did they do? That is towards the installation of pollution control machinery. Okay, now they failed to comply and the grant was refundable. When you refund the grant, what do? You add the grant to the cost of the machine if you have earlier deducted. But then they have said they went back and they recalculated the depreciation. Is that allowed? That is not allowed. So what you need to do is, whatever is the carrying amount, to that you will add the refund, and from this amount you will prospectively calculate the depreciation. So that treatment is not correct. Okay, so that is what is given in the answer, nothing to be calculated. Then is 13, accounting for investment. Gautam invested in shares of another company with the intention to hold the shares for short term on 30th of November at a cost of 425. It also purchased gold of 8 lakhs and silver of 3,50,000 on 31st March of 19. Market values as on 31st March of the above investments are shares 350, gold 1025, silver 510. You are required to explain how will the above investment be shown in the books of Gautam for the year ended 31st March as per the provision of AS 13. So shares is short term 350, 425, lower of cost or market value, which is lower here 350, so you will show it at 350. Then purchased gold in 2019, we are in 22, so generally it looks like it is for long term. So if you take that assumption, gold long term you will carry at cost, silver long term you will carry at cost, both at 8 lakh and 3,50,000. This is an assumption. Gold and silver are generally purchased with the intention to hold it for long term and also because a 3-year period has passed, right. Then Expert Limited issued 12% secured debentures of 100 lakhs on 1st of June. Money raised from the debentures to be utilized as below. Common standard question. Construction of factory building, qualifying asset. Working capital, not a qualifying asset. Purchase of machinery, if it is ready, not a qualifying asset. Furniture, not a qualifying asset. Truck, not a qualifying asset. If you assume this machinery will take substantial period of time to get completed, then it becomes a qualifying asset. Interest on the debentures for financial year 21-22 was paid. During the year, the company invested idle fund of 5 lakhs out of the money raised from debentures in bank fixed deposits and earned interest of 50,000. Now, income earned from temporary investment of surplus is to be reduced from the borrowing cost. Okay. In March, construction of factory building was not completed. It is expected that it will take another 6 months. In March 22, the machinery was installed and ready for its intended use. Furniture was put to use in the end of March 22. Truck is going to be received in April. Now see, these furniture, truck and all of that, these are assets which do not require substantial period of time and hence they are not qualifying asset. You are required to show the treatment of interest as per A16 in respect of borrowing cost. Construction of building, qualifying asset. Now how much is the interest they have given? Interest during 21-22 was paid. When did they take the loan? They took the loan on 1st of June. So June, July, August, September, October, November, December, January, February. 9 months. Okay. 9 months. No, June, July, August, September, October, November, December, January, February, March. 10 months. 100 lakhs, 10 months at 12% means what? 10% of 100 lakhs, that is 10 lakhs. Minus 50,000 temporary investment. So the cost is 9.5 lakhs. Borrowing cost is 9.5 lakhs. Now, out of that, 40 out of 100 is used for construction of factory building. So, you will capitalize 40 out of 100. Okay. Then, purchase of machinery, not a qualifying asset. So, you will charge to P&L. Purchase of furniture, purchase of truck, working capital. None of these are qualifying asset. So, you will charge it to your, P&L. Right. Right. So, with this we come to the conclusion of RTP for CA Inter May 23 examination. Typical question, this question number 20 is a repeat. Okay. This 13 is also a repeat. This is a simple straightforward question. This is again a standard question from A16. This is slightly elaborated, but again, if you know the principles, you can handle it well. And inventory again a standard question, right? So accounting standard as far as your May 23 exams or any exams are concerned, easily I keep on telling it accounts for at least 25 to 30 marks, and if you do well in accounting standard related questions, there is a high chance that you will do well in the examination. All the best.